Hi guys, welcome to Wisemonkey once again. Last video we have seen what do you mean by account and what are the types of account. In this video we are going to learn what are the rules for making an account debit or credit. So which account has to be debited or which account has to be credited? That's a question and we are getting the answer for that question in this video. There are rules to make any account debit or credit. And all these rules are called as golden rules in the language of accounting. We have learned there are three types of account. One is personal account, then we had real account and nominal account. Now when you are going to debit or credit those accounts, so we have rules types wise. Like when you say personal account, so as a person, either you are receiver of something or giver of the something. Say receiver of goods, receiver of cash, giver of goods, etc. So the rule says debit the receiver, credit the giver. Whereas in case of real account, the rule says debit what comes in and credit what goes out. Because real account is dealing with the properties and property can come in business or it can goes out of the business. In case of nominal account, the rule says debit the expenses or losses, whereas credit the income, gain or profit. Because you already know that nominal account is dealing with expenses, losses or gain, profit and income. Now let us understand this better with the help of few examples with the transactions. Suppose in first transaction, business started with cash of rupees 50,000. Now here in this transaction there are two accounts. One is cash account, whereas the another account is capital account. Now you know in types of account we have learned that the accounts of proprietor we write as a capital account when he invests money in the business. Now cash account as per the type we have already learned that is a real account because it's a property. Whereas capital account is a personal account. It represents a proprietor. Now we will apply the rule. What is happening in this transaction? Business is started with cash. So from business point of view, cash is received by business. That means cash is coming in business. So we can say cash comes in business. So this account has to be debited. Whereas in case of capital, proprietor or owner is a giver of cash. That's why this account will be credited because the rule says credit the giver for personal account. Now we'll take second example. Suppose cash is deposited into bank. Now what accounts are here? One is cash account, another is bank account. What are their types? Cash account is a real account. Bank account is a personal account. Real account rule says debit what comes in, credit what goes out. So what is happening here with cash? We are depositing cash into bank. That means cash is going in bank. So cash goes out from the business. So we have to credit it. Whereas bank account is a personal account. What is happening here? Bank is the receiver of money or this cash which we are depositing. So bank is a receiver. So this account has to be debited. Third example, rent paid in cash. Now here there are two accounts. You know that in every transaction there are two accounts. Rent account, cash account. Rent, what is the type of account? Nominal account. Whereas cash is a real account. What is the rule for nominal account? Debit the expenses or losses and credit the gain, profit or income. So here rent is paid, that means rent is an expense. Therefore, debit the expenses, so we have to debit it. Whereas cash is paid, so cash goes out. So again, cash will be credited. Suppose goods are purchased with cash. So here there are two accounts. One is purchase account. Another is cash account. Now purchase account is a nominal account. Sometime in case of purchase we may write goods account, but normally in accounting we write it as a purchase account because we have to specify whether goods are purchased, sales, or it is in closing stock or opening stock. So here the transaction is about purchase, so we are writing purchase account. So purchase account comes under nominal account. Now purchase account is a expense account. So we know the rule, debit the expenses or losses. Purchases is expense, so it has to be debit. Whereas here cash, when you are purchasing goods, cash is going out. First of all, it is a real account. As per the rule of real account, debit what comes in, credit what goes out. So here cash is going out. So cash goes out. So it has to be credited. So from this video, you must have understood how to debit or credit an account. And from these transactions, you must have understood that there are always minimum two accounts involved in each transaction. Sometimes there can be more accounts involved in this transaction. But we have taken simple examples of only two accounts to understand it better in the first stage. Thank you. I hope you must have liked this video. If you have liked it, give a thumbs up. And if you don't want to miss out similar kind of videos on accounting, please subscribe our channel, Wisemonkey.